The global silver market is sending a message that many Western investors still refuse to hear. The Shanghai premium has climbed to $4.20 above international benchmark pricing. That number may appear small to casual observers, but inside the precious metals market, it represents a flashing warning light on the dashboard of the global financial system. It reveals a widening divide between East and West. It shows one side accumulating strategic hard assets while the other side liquidates them into the market. In many ways, the modern silver trade now resembles a slow-moving transfer of financial power across the Pacific. The West continues to treat silver like a speculative trade. Asia increasingly treats silver like a strategic reserve. That difference matters, because history repeatedly demonstrates that nations which accumulate real assets during periods of monetary uncertainty often emerge stronger when the cycle finally turns. The United States experienced this pattern during the industrial expansion of the 20th century. Oil, steel, copper, and silver were not viewed as optional investments. They were viewed as pillars of national power. Today, China and several major Asian economies appear to be applying a similar framework. The rise in the Shanghai premium is not occurring in isolation. It is happening during a period of persistent central bank gold accumulation. It is happening while industrial demand for silver continues to expand through solar energy, electric vehicles, semiconductor manufacturing, and advanced electronics. It is also happening while many Western investors remain heavily concentrated in financial assets that depend entirely on confidence in debt-based monetary systems. That contrast is becoming increasingly difficult to ignore. The Shanghai premium essentially measures how much buyers inside China are willing to pay above global spot prices in order to secure immediate physical silver supply. When premiums rise sharply, it usually signals strong local demand combined with tightening available inventory. In practical terms, Chinese buyers are paying extra because they want the metal now. That urgency reveals conviction. It also reveals concern. No major market willingly pays sustained premiums unless participants believe future supply may become harder to secure or substantially more expensive. This is one reason experienced commodity analysts monitor Asian demand so closely. Asia often reacts earlier to structural shifts in physical markets. Western financial centers frequently focus on derivatives, leverage, and short-term positioning. Asian buyers often focus on actual possession of material assets. That distinction has existed for decades, but it becomes especially important during periods of economic fragmentation and geopolitical tension. Silver occupies a unique position within the global economy. It functions simultaneously as an industrial metal and a monetary metal. Very few assets perform both roles. Silver is essential for solar panels. It is critical for high-conductivity electronics. It is used in medical technologies, military systems, and industrial applications that modern economies cannot easily replace. At the same time, silver has preserved purchasing power across civilizations for thousands of years. That dual role creates a powerful structural foundation for long-term demand. Industrial consumption removes significant quantities of silver from circulation each year. Meanwhile, investors seeking protection from inflation, currency debasement, and financial instability continue to accumulate physical supply. The result is a market that can tighten rapidly once investment demand accelerates. Recent years have introduced several additional pressures. Global mining production has struggled to expand at the same pace as industrial demand. Permitting challenges, environmental regulations, rising energy costs, and declining ore grades have complicated supply growth. New mines require substantial capital and long development timelines. That means production cannot instantly respond to sudden demand surges. This dynamic creates vulnerability inside the physical market. When buyers aggressively compete for available supply, premiums begin to rise. The Shanghai premium is therefore more than a regional statistic. It is a signal regarding the balance between physical availability and global demand. The timing of this development is particularly important. Many Western economies are now carrying debt burdens that would have appeared extraordinary only 2 decades ago. Government deficits continue expanding. Interest expenses are rising. Central banks face mounting pressure to maintain financial stability while also attempting to control inflation. These competing objectives create difficult policy trade-offs. If rates remain elevated, economic growth slows. If monetary conditions loosen too aggressively, inflationary pressures can reaccelerate. Investors across Asia appear increasingly aware of these risks. That awareness may partially explain the willingness to pay elevated premiums for physical metal. Throughout history, populations exposed to repeated currency instability often develop stronger cultural preferences for tangible wealth. China, India, and several Southeast Asian economies maintain deep historical memories of inflation, political disruption, and monetary transition. Physical gold and silver ownership therefore carries both financial and psychological significance. In contrast, many Western investors spent decades operating inside an environment dominated by expanding credit-rising asset prices and relatively stable currencies. That experience encouraged confidence in paper wealth. Stocks, bonds, and technology companies generated enormous returns. Precious metals frequently appeared unnecessary. But cycles eventually change. The world economy today looks increasingly different from the environment that defined the previous generation. Supply chains are being reorganized. Trade relationships are shifting. Energy security has become a national priority. Military tensions between major powers continue rising. At the same time, confidence in long-term fiscal discipline across many advanced economies has weakened. Under these conditions, hard assets begin attracting renewed attention. Silver becomes especially important because it remains relatively small compared to other global markets. That small size means large inflows of investment capital can move prices dramatically. A relatively modest increase in institutional demand can tighten available supply much faster than many investors expect. This is precisely why developments in Shanghai matter. The premium indicates real buyers are stepping forward despite higher local costs. That behavior suggests they expect future value to justify current premiums. Western markets, meanwhile, continue sending mixed signals. Large volumes of silver trading still occur through paper contracts rather than physical delivery. Derivative activity often influences short-term pricing far more than immediate supply conditions. Critics argue this structure can temporarily suppress price discovery. Supporters claim it improves liquidity and efficiency. Regardless of perspective, the divergence between physical demand in Asia and financial trading patterns in the West is becoming increasingly visible. The broader implication extends beyond silver itself. The rise of the Shanghai premium reflects a changing philosophy toward wealth preservation. Asia appears increasingly focused on securing strategic resources and tangible assets. Much of the West remains concentrated on financial engineering and debt expansion. One approach prioritizes possession, the other prioritizes leverage. History will ultimately determine which strategy proves more resilient, but the market is already providing clues. When buyers willingly pay above global benchmarks for immediate physical delivery, they are expressing a clear preference. They value certainty over convenience. They value ownership over promises. And in an increasingly uncertain world, that distinction may become one of the defining financial themes of the decade. The movement of silver toward Asia is not simply a short-term trading event. It reflects a deeper transformation inside the architecture of the global economy. For decades, Western financial systems dominated commodity pricing, capital allocation, and reserve management. New York, London, and other financial centers controlled the major flows of global liquidity. But over the last 20 years, Asia steadily expanded its industrial capacity, manufacturing strength, and strategic influence across critical supply chains. China became the largest consumer of many industrial commodities. India increased precious metals. Imports as household wealth expanded. Southeast Asia developed into an increasingly important manufacturing base for global technology production. As this transformation accelerated the center of gravity within commodity, demand also began shifting eastward. Silver sits directly at the intersection of this transition. It is no longer viewed only as a traditional store of value. It is now deeply connected to the future of industrial growth. Solar energy remains one of the most important examples. Modern photovoltaic panels require substantial quantities of silver because of its unmatched electrical conductivity. Governments around the world continue investing heavily in renewable infrastructure. China alone dominates a large percentage of global solar panel manufacturing. This creates enormous structural demand for silver that extends far beyond speculative investment. Electric vehicles represent another powerful driver. Advanced automotive systems depend on high-performance electronics and conductive materials. Silver plays a critical role inside these technologies. Semiconductor manufacturing also consumes meaningful quantities of silver in specialized applications. As artificial intelligence, cloud computing, and digital infrastructure expand worldwide, the industrial importance of silver continues rising. This is one reason the Shanghai premium deserves careful attention from institutional investors. It signals that physical buyers inside Asia understand the strategic value of securing supply before shortages become more severe. The Western investment community, however, often remains focused on short-term price fluctuations. Many portfolio managers continue viewing silver as a volatile trading asset rather than a strategic long-term holding. That perspective may prove increasingly outdated in the years ahead. History provides important lessons during periods of monetary transition. Empires and dominant economies rarely lose influence all at once. The process usually unfolds gradually through debt accumulation, currency expansion, declining industrial competitiveness, and shifting trade relationships. Throughout history, hard assets often gained importance during these transitions because they carried no counterparty risk. Gold, silver, energy resources, and industrial commodities became forms of financial insurance against systemic uncertainty. The modern global economy now faces several pressures simultaneously. Inflation remains structurally higher than many policymakers expected. Supply chain vulnerabilities continue disrupting production networks. Geopolitical tensions between major powers are forcing corporations to reconsider manufacturing dependencies. Governments are increasing defense spending while also attempting to finance social obligations and infrastructure programs. These conditions place extraordinary pressure on fiscal systems, already carrying historically high debt loads. Central banks therefore face limited flexibility. If interest rates remain elevated, economic growth weakens, and debt servicing costs rise sharply. If monetary policy becomes too loose, inflationary pressures can accelerate again. Investors observing these dynamics increasingly seek assets outside the traditional financial system. Asian markets appear particularly sensitive to these risks. Physical ownership continues receiving strong cultural and institutional support across much of the region. The rise of the Shanghai Premium reflects that mindset. Buyers are not merely speculating on price appreciation. Many are attempting to secure access to a strategic resource before future market disruptions emerge. This behavior resembles earlier periods in financial history when nations accumulated commodities ahead of major economic realignments. During the 20th century, the United States built enormous strategic reserves of oil, industrial metals, and agricultural resources. Those reserves supported economic expansion, military readiness, and industrial dominance. Today, China appears focused on developing similar resilience across critical supply chains. Silver fits naturally into that strategy because it supports both industrial production and monetary security. Another important factor involves the structure of the silver market itself. Compared with equities, bonds, or global currency markets, silver remains relatively small. Annual mine supply is limited. Above-ground inventories available for investment are smaller than many investors realize. Large institutions entering the physical market can therefore create rapid supply tightness. This dynamic becomes even more important when industrial demand continues absorbing significant production each year. The combination of industrial consumption and investment accumulation creates a potentially powerful long-term imbalance. The Shanghai Premium may therefore represent an early signal rather than a temporary anomaly. The future direction of the silver market will likely depend on one central question: whether the physical market eventually overpowers the pricing influence of paper derivatives. For years, critics of the existing system argued that futures contracts and leveraged trading structures created artificial downward pressure on silver prices. Supporters of the system maintained that derivatives improve liquidity and help producers manage risk efficiently. Both perspectives contain elements of truth. But the growing divergence between physical demand in Asia and financial trading patterns in Western markets suggests the balance may gradually be changing. Physical buyers ultimately require actual metal. Industrial manufacturers cannot build solar panels or advanced electronics with paper contracts alone. If demand for immediate delivery continues strengthening while available, inventories tighten the physical market, may exert increasing influence over global pricing mechanisms. This possibility explains why many experienced commodity analysts are paying close attention to developments inside Shanghai. The premium itself is important not because of the exact number, but because of what it represents psychologically. It signals urgency. It reveals that buyers are willing to absorb higher costs today because they expect greater scarcity or higher prices tomorrow. Financial markets often move according to shifts in collective perception before official economic data fully reflects underlying reality. By the time broad consensus recognizes a structural trend, the largest gains are frequently already gone. This pattern has repeated across multiple commodity cycles throughout modern history. Oil, uranium, copper, and agricultural products all experienced periods where physical shortages developed long before mainstream investors fully appreciated the implications. Silver may now be entering a similar phase. Several conditions support that possibility. Industrial demand continues expanding through renewable energy infrastructure, digital technologies, and defense applications. Mining supply growth remains constrained by rising production costs, regulatory challenges, and declining ore quality in several major regions. Meanwhile, global debt levels continue reaching new highs, while confidence in long-term monetary stability weakens. These forces collectively create an environment where tangible assets become increasingly attractive. Western investors may eventually reconsider their approach toward precious metals. For decades, many portfolios prioritized technology equities, government bonds, and growth-oriented financial assets. That strategy performed exceptionally well during an era defined by globalization, low inflation, and aggressive monetary stimulus. But economic conditions are evolving. Inflation volatility, geopolitical fragmentation, and rising fiscal pressures are forcing investors to reassess traditional assumptions. Hard assets are beginning to regain strategic relevance. Silver occupies a particularly interesting position because of its affordability relative to gold. Many retail investors can accumulate meaningful quantities of silver more easily than gold. This accessibility has historically allowed silver to attract broad participation during periods of financial uncertainty. Institutional demand combined with rising retail accumulation can create powerful momentum once confidence shifts decisively toward tangible stores of value. The rise of the Shanghai Premium therefore carries symbolic importance beyond the precious metals sector itself. It reflects a broader reordering of financial priorities between East and West. Asia appears increasingly focused on securing resources, production capacity, and physical ownership. Much of the Western financial system remains concentrated on leveraged debt expansion and complex financial engineering. One philosophy seeks resilience through possession of tangible assets. The other seeks growth through expansion of credit and financial abstraction. Both models generated success under different historical conditions, but the current environment may increasingly favor nations and investors holding strategic, real-world resources. This does not guarantee immediate price explosions or overnight systemic change. Financial transitions rarely occur in dramatic single moments. They unfold through gradual shifts in capital flows, industrial priorities, and investor psychology. Yet markets often provide early indicators for those willing to observe carefully. The Shanghai Premium may be one of those indicators. It suggests that sophisticated buyers inside Asia are acting with long-term conviction, while much of the West remains distracted by short-term volatility. History repeatedly rewards those who recognize structural transformations before they become obvious. Silver now stands at the center of one of those transformations. The metal, once dismissed as an old world relic, is increasingly becoming a strategic asset for the modern technological economy. And while Western markets continue debating temporary price movements, Asia appears focused on securing the physical reality underneath the financial noise. That distinction could define the next major chapter in the global precious metals market.